Hi everyone. My name is Pai. I'm the CIO at SCB 10X, and I'm thrilled to be here with Diogo, co-founder of Anchorage Digital and general partner of Haun Ventures. Hi Diogo, it's good to see you again.
How's it going, Pi? Great to see you too.
Yeah. So Diogo, let's talk about this. So you have had quite a journey from being a security engineer at Square and Dogger to co-founding the first federal charter crypto bank, and now transitioning to venture capital at Haun Ventures. What drove you to make these career pivots, and how has each role informed your understanding of what institutions really need from crypto infrastructure?
Yeah, it's been interesting because it's really been a career progression. At no point did I feel that I was doing something different, and I run you through why. So if you really think about my career, for the past 20 years, I've only really done one thing. So I started by doing research in distributed systems and security. I have a PhD in distributed systems and security. And so I was doing academic research in the
Mm,
same space. In fact, I was working on some of the core fundamentals that Sybil detection and Sybil protection that Bitcoin really started to solve. And one of the major innovations from Bitcoin back in 2007, 2008, before Bitcoin white paper was out. And so I
right.
was doing academic research in that focus. And then it wasn't really a pivot. It was just a natural extension of, I was a very early employee at a company called Square. So Square flew me out of Lisbon in 2011 while I was finishing my PhD. And so if you think about that natural transition was as an academic that had done research in this area, I really wanted to apply my knowledge and work on cryptography, work on distributed systems, build large scale systems, which is fantastic because I did get to do just that over the next 4 years at
Mm,
Square. And so I was able to lead the platform security team and protect billions of credit cards and build a platform in a fintech that still today is one of the world's most valuable fintechs and one of the largest fintechs ever. And then from that, I started my own company, and Nathan and I actually met at Square almost
mm,
15 years ago. And that progression was very easy because if you're an engineer and you're in Silicon Valley, you're inspired by all these other founders. So you want to be a founder too. You want to run these companies. And so I decided to do it. And that was a natural progression too. And then last year, I promoted myself to executive chairman of Anchorage, and I started dedicating my time more to investing. Why? Well, the natural transition also happened. I was doing angel investments. In fact, I have over 150 angel investments across all of my portfolio. And so it was natural for me to professionalize my
mm.
mini golf into golf. And so to a large extent, I've only done one thing, which is I've been a researcher in security and distributed systems. I've been an operator in security and distributed systems. I've been a founder in security and distributed systems. And I'm also an investor in security and distributed systems. And candidly, what I've reached today is really an ability to do
Mm.
operate, do company building stuff, and invest simultaneously with different percentages of my time, which candidly, I could not have created a more perfect job that suits my skill set and my likes.
Yeah, I think that's amazing journey you have. I don't think I've ever come across anyone with, research experience, operational experience, and now you start up entrepreneur experience and then move to investors. So you kind of have like full cycle of like, how to look at things. And then, yeah, I'm curious, like in 2017, you mentioned you and Nathan kind of found Anchorage, and you were essentially just two security engineers asking institutions to trust you with billions in digital assets. So what were the biggest challenge in convincing early institution clients, and how did you overcome the credibility gap that led to today's success of Anchorage?
So one of the things that was fantastic when Nathan and I started Anchorage was that there were no credible institutions that solved this problem, period. And so that gives you a major advantage because anybody that is half legitimate that shows up actually has a major advantage. It's not like at the time we were competing against, JP Morgan Chase had a crypto Bitcoin custody solution, and here comes Nathan and Diogo and tries to convince you that instead of using JP Morgan Chase, you should use Anchorage Digital, right? That's not what was happening. There were really no real solutions in the market. And the insight for us is that the real problem to solve, and that is still true today, was fundamentally a technological problem, and specifically a security problem. How do you protect keys that are worth tens of billions, if not hundreds of billions of dollars, and are completely irrecoverable if you make a mistake? That is
Mm-hmm.
unlike the traditional financial industry in which there's reversibility, there's chargebacks, there's all of these ways for you to just reverse mistakes. Here, there's no reversing these mistakes. If the Bitcoin leaves a particular private key and is transferred out of it, then all of a sudden you can't recover it. You
Right.
just can't do anything about it. And so we looked at it as who better than two security engineers that have worked together every day for 7 years, worked on cryptographic systems, worked on hardware security modules, have built large scale systems in very legitimate fintechs, are better to build one of these companies. And so that's how it started. In fact, the original impetus for Anchorage Digital came out of need. There was a fund
Mm.
that lost $1.5 million of a Bitcoin wallet and offered me 20% if I could break into it. That was really how the initial conception of very sophisticated investors were really not very sophisticated at private key management and operational security. And so there was a niche. So that's how it started. And part of the legitimization was exactly that. The hard problem to
Mm.
solve was not the regulation, was not the go to market. The hard problem to solve was, do you have technology that people can trust that won't have issues of loss or get hacked and ultimately leads to fund loss?
Yeah, so lucky to that fund that met kind of two security engineers that know how to solve
Yeah,
it, right?
it's kind of
Yeah.
funny. So I remember Chris Dixon at the time. I hadn't heard this in 2017, but Chris Dixon at the time, he was talking to me and said, "Hey, actually, this is an interesting one because this is a perfect founder market fit." That's how I described it. And
Mm,
so, perfect founder market fit. Usually, we have perfect product market fit, but this
right,
case, it was founder market fit. It was like we were the perfect team. We had worked in regulated entities. We had helped take Square public. We had worked on compliance. We had worked on hardware. We had
right.
worked on software. So it was really perfect founder market fit.
Yeah, I think that's perfect combination you have. And I think not only convincing institution clients, but you also successfully convinced a regulator as Anchorage became the first crypto company to receive a federal banking charter in 2021, which was a historic milestone. Can you walk us through that regulatory journey and the key factors that made the OCC comfortable granting that charter?
Yeah, absolutely. So if you think about the path of Anchorage, is kind of an interesting one, which is pretty straight path. We knew what we wanted to do day one. We wanted to solve the problem for large institutions to be able to participate in crypto with confidence. And the first thing to solve was the technical aspect. Can you build a custody system that can protect and withstand attacks at the level of hundreds of billions of dollars, if not trillions of dollars in the future? So that was really the problem to solve. Can you build a product? Can you support all these assets? Can you stake with them? Can you do governance and vote? These assets are weird if you think about them. Like they require active participation. There's lots of things to do, and all
Mm,
blockchains are different. So supporting them is a very engineering intensive effort. So that was the first problem to solve. The next problem to solve was an institution wants to work with another regulated institution. And in fact,
mhm,
many of them not only don't have the abilities to build this type of custody solution and security solution internally, but many of the financial institutions don't even have the ability of introspecting and doing due diligence on the technical aspects to really
mhm,
decide whether it's good or not. So the reality is that a lot of the market works in a very efficient manner. If a company is a public traded company, you know that the SEC enforces all of these rules and regulations around transparency and disclosure. So you actually can be pretty confident that the numbers around revenue and et cetera that are displayed on a K1 actually are real. So that's you're borrowing confidence from the regulatory apparatus and systems, which is amazing because more confidence means a lot less friction in commerce. And for
right.
us, it was the same thing. The only better thing than a great security platform to custody for institutions was a regulated platform to custody for institutions. And that benefited us in two ways. Number one, it validates to the market that we went through all these audits and all the scrutiny from the regulators and
Mhm,
continually do so. So it validates that we're doing what we said we're doing. But more than that, it allows people to trust the charter instead of trusting the technical security aspect. So to a certain extent, it reduces the friction of a company having to come in and do due diligence because number one, the regulators have done it, and also at this point, the
mm,
largest financial institutions in the world, like BlackRock, have done so too, right? And so now it's much easier because people can borrow conviction and can borrow due diligence from all of the thousands of clients that Anchorage has had for the past 8 years, right? So that's a big advantage. Really, the goal was always if we want to serve institutions, we have to build the right product with the right security, and we have to have the right regulation. And
mhm,
We did so, and we were the first ones, and we're still the only ones, which is kind of fascinating. Of course, right
Mm-hmm.
now there's, as you've seen with stablecoins, there's a big push towards regulated financial institutions that allow crypto rails to exist, and there's a big push for other OCC charters. And so I really hope that we are not the only one 12 months from now,
Mm-hmm.
because it's much better for the space to be under this regulatory regime. But it was amazing blazing that trail, and still one of the things that I'm the most proud of at Anchorage have been to kind of like run the OCC and really bring the regulators along us. Like the first time we were having these conversations, they didn't really understand what staking
Mm-hmm.
was, like the conversations around Bitcoin were very early. So we've spent a lot of our time and effort bringing them along, showing them the technology, showing them that these things are not that scary, that we can meet all of the regulatory needs, all of the ML, all the KYC, all of the KYB, all of the travel rule. You can meet all of these regulations that exist for financial industry in the crypto world too. And so we were the first ones to demonstrate that.
Yeah, I think it always sounds easier when you talk about it now, but then I think the
Yes.
process will be as I imagine it is pretty painful for you. Like maybe what advice you want to give for founder that like want to may need a trust like this in the future and how to deal with regulator, like any advice?
Yeah, so look, I don't know if there's advice other than persistent, but let me tell you, you're absolutely right. The way that I describe being an entrepreneur and being a founder is when you're a founder, you wake up and every day you get punched in the face. That's it. That's what being a founder feels like. And then being in a regulated entity as a crypto company, getting the first federal charter in the United States, you wake up, you get punched in the face, and you get punched in the stomach. So you get punched twice per day instead of just once per day. So
Right.
it's much harder. And of course, like capital intensive, extremely high scrutiny. As you know, the prior administration was not, of the United States, was not a fan of crypto. That brought in even
Mm,
further scrutiny. So it's not that Anchorage had to meet the rules of the road. Anchorage had to surpass all of them. We really were met to a much higher standard than even traditional banking was. And you can look at this in two ways. The rules are the rules, and they shouldn't have done it, and we should meet the bar, and that's it. And another way you could say, look, it's a new thing, and so the regulators are particularly extra cautious around this, so that they can actually understand what's happening. I think both sides have some good claims here. But ultimately, what matters is that we're past that. We're very proud of the work. The thing that we know about humanity, by the way, is that the things that you remember
mhm.
and the things that are worth it are usually the things that are the hardest. Um, if something is easy, it doesn't have much value. And this
Right.
was extremely hard, which is part of the reason why it has so much value. So much value from a business perspective, so much value from, I guess, an equity valuation perspective, and also from a personal perspective, value in terms of like pride and the team rallying around it, and knowing that if you worked at Anchorage, you knew that you were pushing the boundaries of regulation, and you knew that we were doing the right thing to bring crypto into the regulated perimeter of the United States, which is something for a long time was the main criticism of folks outside of crypto, was that crypto was totally unregulated in the wild, wild west. And here we were, Anchorage Digital, getting a charter and meeting the
Right.
rules that were there and meeting the exact same standard as traditional banks. And
Mm.
so, yes, it was hard, but it was worth it.
Yeah, I'm glad you made it. You kind of paved the road somehow for other startups, I think. And I can imagine you got punched at the face and the stomach many times because you actually been in multiple cycles already since founding
That's right.
Anchorage. And how has your approach to building custody infrastructure evolved as the market has matured, given you experienced all many cycles? And what lessons have you learned about building resilient business models?
So I think the majority of the lessons have to do with the market and the volatility. The infrastructure itself, there's also been lessons there. And if you think about it, Bitcoin as a technology hasn't really changed that much from 10 years ago. There's been
Mm,
updates, but it's on purpose a technology that changes very slow, because the goal right now that a lot of people ascribe to it is this store of value. And we want store of values not to change and not to take dramatically risky positions in terms of technology and in terms of feature set. So, that's why Ethereum and Solana and all these other networks end up showing up, is because they really want to be a smart contract platform and world computers, and Bitcoin wants to maintain itself in this in this corner of the crypto asset world. So that's important. That's important to note. So that has evolved. The technology has evolved. In the beginning, it was just Bitcoin custody, then it was staking, then it was governance, then there was all of these other complications from a technology perspective, multiple cryptographic mechanisms, people kept inventing new ways of doing stuff, smart contracts become very complex, there's bridges, there's from a technology perspective,
Right.
things that evolved. But from a learnings perspective, I think the interesting thing is a founder in a traditional business is it's extremely hard to be a founder in a traditional business. But now imagine a business in which every 3 years or so, 80% of your revenue disappears. That is founder and founder squared. It's founder in hard mode because guess what? Your revenue disappears, but the number of people you have on your team do not. And so now you have
Right.
a major mismatch in terms of what you've estimated. And it's very hard to predict. Like people can't really predict macro. So it's extremely hard to predict and it's extremely hard to deal with because are you aggressive and higher? And are you in a situation where your burn just massively increases and now you're burning off money off the balance sheet? And so how do you deal with reserves? How do you deal with planning? How do you deal with treasury? How do you play the cycles? And also, how do you deal with the market itself? Not all crypto companies are like Anchorage, in which we are very exposed to crypto prices. Custody and staking are businesses that we do, and trading that are traditionally correlated to
Right.
prices. When prices go up, we make more money on custody and staking. That's pretty obvious. And prices go down, we make less money. There's businesses that are just recurring revenue, more platform type fees, something like
Mhm.
Chainalysis. It's more resistant to market volatility. Even though when obviously there's a bear market, people need less compliance tools because they're probably doing less business and not as many businesses are starting. But in general, it's much more resilient to the ups and downs. Anchorage in the beginning, it was just directly correlated 100% with the markets. And so it was, some multiplier on the price of Bitcoin. And that was what it was. So you really, as a founder and as an operator and as a CEO, have to look at your business and say, hey, how do I actually get this to be more predictable? Because ultimately, that's what the public markets will demand of me, predictability. So
Mm.
how do you get it to be more predictable? How do you actually get to also make money when the markets are down? And so
Right.
the learnings are about how do you turn a dominant position in a business that you love, that gives you a lot of upside because we strongly believe that over the long term, crypto markets will continue to grow. That's a fundamental belief. But in the meantime, how do you maintain the business? So
Mm.
diversification of revenue, getting stable coin like business so that it's dollar denominated, turning very high custody fees into actual platform fees, into recurring revenue, into things that have auto renew, and turning a lot of the business and a lot of the revenue into something that's more predictable, even though not all of it, because you still want to maintain that like massive upside to crypto. Can you have your cake and eat it too? Is a little bit of the question. So a lot of the learnings have come from there. Also on culture, how do you have a culture in which when there's a bear market, not 50% of people don't quit? Because it happens
Mm.
and has happened to so many
Right.
companies in this 2017 bear market. Um, Specifically, it people come in because crypto is running hot, prices are high, people are excited. The moment the prices go down for 2 years, it takes a pretty tough stomach to take care of that volatility and look at the company and you no longer see hockey stick growth. And so you're wondering, what am I doing here? And so if you did not have a culture and you did not actually filter people for high crypto conviction initially when you hire them, you're going to get yourself in a very, very difficult situation when you start having churn that can go all the way to 40 to 50%. So how do you protect against that? How do you actually
Mm.
instill a culture and instill a hiring practice that actually maintains minimum volatility in terms of churn when people actually are disappointed with the crypto prices? How do you actually get to be inspiring enough to know that, you build into bear markets and you reap the rewards in the bull markets? And that's
Right.
hard. And those were a lot of learnings that are not crypto specific, but definitely crypto requires of founders to be a lot more resilient in all of these than just traditional companies would.
Yeah, I think, yeah, managing the people, I think during cycles, yeah, it's a hard one. And I think also for business model side, I think you seems to be able to crack it because I think for custody is take the percent cut of the AUC, and I think you seem to make it more stable by introducing like subscription model and those kind of thing. Yeah. So now I would like to hear more about the evolution of custody tech. Diogo, from a technical perspective, how has crypto custody evolved from the early days of cold storage to today's sophisticated security architecture? Can you explain why Anchorage chose to move beyond traditional cold storage and what advantages multi-party computation offers for institutional clients?
Yeah, so the technology has evolved quite a bit, but if you think about it, when we started in 2017, the gold standard, and many people still use this, was what I call pirate custody. It was literally the same technology that the pirates used in the 1700s to protect their gold coins. You have gold coins that you want to protect, and so you find a chest with a key and lock. You throw your gold coins inside of it, you bury it in an island somewhere, and then you create a little map that you save with your life on where you actually stored your treasure. That's it. That's basically how cold storage operates. There was, except that instead of treasure chests, it was safety deposit boxes, and instead of gold coins, it was USB keys with actual private keys inside of them, right? But it was the same type of mechanic, is what I lovingly call pirate custody. So that was hilarious. Obviously, we didn't do that. Maintaining something that is cold storage is extremely important still, but the cold storage parts that matter are you never connect a system that is a sensitive system directly to the internet. You never want to have that vector of attack. And you can do so by storing things in a safety deposit box, but you can do so in many other ways that are much more technologically sophisticated. And not only that, you can add all of these layers of security on top so that your authorization and all the logic of should this transaction move or not is not being implemented by humans with checkboxes, which is what cold storage is. It's a human with a checkbox that they go and did they do the right thing. And humans do the wrong thing all the time. They're distracted, they're sleepy, they do the wrong thing, whatever. So they having a bad day. Computers, on the other hand, if you build them in the right way, they always do the same thing, and they're never tired and they never sleep. And so we were able to replace both the policy engines and replace the human side of this and
Mm.
maintain the offline nature of the assets so that our assets at Anchorage would never actually directly touch the internet. So that was extremely important. It was a major innovation, is what we've built, the fundamental technology. And across time, that is maintained pretty consistent. There's been evolutions of this, but the core technology maintains to be very consistent. In the meantime, though, there's been a push for more active transactions and transactions that aren't online. Lots of exchanges, a lot of NFTs, all of these types
Mm.
of excitements have led to people wanting to do, instead of thousands of transactions per day, can we do millions of transactions per day? And so the technology has evolved, and people started doing threshold signing, started doing multi-party computation. So many variant multi-sig still existed and continues to exist, but many variations on can you actually split the responsibility to move a
Mm.
sensitive asset from one location to many locations? How can you do that? And there's many ways that you can do it. To a large extent, MPC is mostly a marketing term these days. The way that you implement MPC could be amazing and it could be horrible. MPC, you could have one host that runs all of the three MPC nodes on the same host
Mm.
and all the shards, and it's the same thing as having one private key in memory. So if you think about that, is like the implementation, the devil's all in the details. The implementation matters. Of
Right.
course, multi-party computation is a very powerful technique, and generally, it's actually something that is great in your tool belt, but it's not really a custody solution. In fact, multi-party computation doesn't tell you how you store the keys. It tells you how you generate them and how you actually do the signatures, but it doesn't tell you where to store them. You still need a safe place to store them, the shards and how to distribute them and how to back them up, etc. So technology has evolved. There's lots more tools, and we're using all of these in our different products. Ultimately, what matters is still what mattered in 2017 when we started the company, which is
Mm.
great security engineering, great view over what is the attacker model, what is important, not get yourself like pulled by the market into doing something that is wrong or into using a technology that is either not mature or there's not the right technology for the actual issue. So things have evolved dramatically. I think part of the push has been faster transactions, blockchains like Solana that are much faster than
Mm.
Ethereum and then Bitcoin. The throughput, like everybody wants to do millions of transactions, and obviously the amounts of money that are being moved have also increased. So all those things have created a little bit of a push for people to change the technologies and to change what they actually have done from an infrastructure perspective.
Mm. So more on like technologies kind of evolve to support more transactions and also more rules that people may want to set. Yeah, that
That's
makes
exactly
sense.
right. And really, if you think about it, the institutions that were here in 2017 are not the same today.
Right.
BlackRock has very different requirements than a small venture fund that was getting into crypto in 2017. So that has also evolved in terms of the APIs, the products, what you support, the regulatory stack. All of that is like inherent in technology. The compliance, how you do the travel rule, how do you do QIC, how do you do QIB. All of that
Mm.
also has had to be completely refreshed from 2017. So the technology looks very different, even though
Mm.
the ultimate goal still appears to be the same, which is custody and stake and govern in a secure manner.
Yeah. Diogo, another aspect that heavily impacts custody provider is the regulatory, and we have seen significant regulatory shifts this year, including the FDIC's new guidance allowing banks to engage in crypto activities without prior approval. How do you see these regulatory change impacting the custody landscape? And do you think traditional banks will become major competitors to crypto native custody providers like yourself? And do you see them, if you see them as competitors, what advantage do specialized crypto institutions maintain, and where might traditional financial institutions have the upper hand?
So there will come, and they're already here to a large extent. I think historically they haven't been successful. Part of the reason is because there hasn't not been clear regulation. And as you know, these banks are very traditional, and they're not going to do anything that
Right.
is not extremely clear in terms of regulatory. So do I see them as competition? I think it's co-opetition, which is we compete in small
Mm.
slivers, but in general we collaborate. They hold our fiat, they hold our T-bills. We help them do sub-custody for some of these large institutions. And so it's really, we use specialization, and we specialize on what we do best, and they specialize what they do best. Ultimately, I think the big banks will come, but if you think about the risk posture, like some of them maybe will get to Bitcoin custody. They will not do staking. They will not do Solana. They won't go like, it'll take them a
Mm.
long time. They will do it eventually when it's become so mainstream that it's obvious, but it'll take them lots and lots of time. In the meantime, Anchorage supports thousands of assets, and they don't even support one. So if you think about it, it's not that you have to build the things that we've built to meet the level of product that we have, is that you have to keep pace. And let me tell you, the pace is
Mm.
extremely high. And so that favors small, nimbler teams, highly technologically competent that have built these products that have already clients in the market. And at this point, we have the world's largest clients already, and we're onboarding them and continue to onboard them. And so to a certain extent, like they're already onboarded to us. So will they have and will they favor the traditional relationships? Maybe in certain cases, but definitely not in all. And so it really is a competition, and we will use them in certain cases. They
Mm.
will use us in certain cases, and the clients actually have more choice, which ultimately is much better for capitalism and helps everyone. So I fundamentally believe that. From a regulatory perspective, we're in a very interesting situation. Genius Act passing is extremely good news, and custody is becoming even more exciting. Specifically, our federal charter. We're still the only federal charter bank in the U.S., and the Genius Act says that you need to be a federal charter to issue stablecoins. And if you could be a state charter over $10 billion, you have to upgrade yourself to the federal level of oversight. And so the reality is that all of these stablecoin issuers and all the excitement of stablecoins is directly linking back to custody and issuance, which then is
Mm.
directly linking back to the excitement of our business. So it's an extremely exciting time. In fact, I don't remember ever as more exciting time, because there's so many things. It's not just Bitcoin doing extremely well and reaching all-time highs. It is clear product market fit in stable coins, $250 billion of issuance, the largest players like Bridge acquiring companies that just acquired yesterday, a company called Privy, which I was an angel and was on our portfolio. They acquired
Mm.
Bridge, which I was also an angel, was also on our portfolio. So they keep acquiring these crypto companies. This is one of the largest fintechs in the world, one of the largest private companies in the world that is seeing the future in crypto and is going like and acquiring everything that they can to really dominate. You've also seen Visa with partnerships, MasterCard with partnerships. All these things are benefiting us. Crypto is no longer one thing. It's so many things and many things that are working. And so, yes, it's extremely important to have a regulated partner that does the custody, does interaction with the blockchain. And so it's never been more exciting for custody than it is right now.
So yeah, I think it's co-opetition if you call that, and then maybe take different piece. And I think, yeah, I think
But the
I kind
market
of
is also
see the
getting so much
same.
larger. And
Yeah.
you have to realize that we have advantages in the US, we have advantages in Southeast Asia, we're regulated in
Mm.
Singapore, but there's many other markets. And so there's going to be places for local players, smaller players, larger players. Some people specialize in high transaction throughput. Some people specialize in
Right.
SMB, some people specialize. So you'll have all of the diversity that you have of current financial institutions in this world too. And the market is becoming so much bigger. So the opportunity is much bigger, even if there's more competitors.
I see. And I think, given Anchorage global reach, how do you see customer needs and regulatory approach in Southeast Asia differ from Western markets? And what opportunities do you see in this region that has some of the highest crypto adoption rates globally?
Yeah, highest crypto adoption rates, also of stable coins. Lots of business. If you have a business center, you're going to have remittances. You're going to have cross-border payments. You're going to have pay-ins, payouts. And so that's part of the reason why Singapore is one of the biggest hubs for stablecoins right now is because there's lots of business. Whenever there's a corridor that is actually sending
Mm.
funds back and forth, you're going to see stablecoins in between and crypto companies in between. So there's lots of opportunity right now. In terms of regulation, obviously each regulator has to decide on their own. To a large extent, I think international regulators outside of the US were tired of waiting for the US. In many
Right.
cases, the US regulates first and everybody copies. In this particular case, has actually not been the case. MiCA came first. Singapore was much earlier. Dubai was much earlier. And so now we have to make sure that these rules and regulations sort of like work well with each other. And so there'll be a little bit of of emerging and of understanding of how they're actually supposed to work together. But to a large extent, we haven't won yet. There's a lot missing on how stablecoins should be governed.
Mm.
Stablecoins are inherently a global phenomenon, for example. So if I issue a stablecoin in the US, but it's mostly being used in Singapore for peer-to-peer payments, how does that work? Under which
Mm.
jurisdiction is it in? Who's the regulator? Where are those T-bills? Which company is actually being booked in terms of revenue? If it's like one asset, truly global phenomenon, how do you do this? It's extremely hard. It's an extremely hard problem. There's somewhat easy solutions, but ultimately the regulators have to collaborate on something that is actually approachable and that works for both parties. So there's still a lot of wood to chop, a lot of regulations to come. If you think about
Mm.
it, only the Genius Act has been passed. Fit 21, which is the infrastructure bill that told us which regulator actually regulates commodities or securities and what is what in a test of whether something is a security or a crypto commodity, that hasn't been passed. That hasn't been making that much progress. And so to a large extent, there's still a lot more to do in the US and internationally for sure.
Mm. How do you like keep up with all the like regulatory change and I mean in terms of like adjusting all the business side? Like yeah, it's just it's like yeah.
I spend a lot of time on the internet is the answer.
Yeah, because I think by the time you see it, it's probably a bit too late, right? But yeah, so
So one of the things that does happen, and by the way, one of the beauties of being an operator and being an investor simultaneously is that you get to see things very early. Either you
mm,
get to see them because people want to be supported by Anchorage and they want us to custody. It's kind of fascinating. Anchorage is such a good brand as like the best institutional custodian in the US that if you want institutions to invest in your asset and invest in your project, you need to be supported by us. We've gone to that level. And so people come to us early and I get to see lots of fun stuff there. And on the other side, I have a checkbook, right? I have a checkbook at Haun Ventures, and we also get to see lots of early stage
hmm
investments. So really, these things work together extremely well, and I get to see very early projects. And then, what a privilege it is to be a venture investor and to have the smartest founders come to you to explain in a very simple terms, such that a VC brain can actually understand it, what they're doing and why, and you get to ask questions. And that's such a privilege, and it makes learning so much faster. So it's part of the reason why I love this combination of the roles and love the role of doing early stage investment and late stage investment is that you get to see everything and you get to form opinions and you get to be
mm.
candidly fed information, like high quality information, and get the ability to interact with these amazing founders. So yeah.
I see. Yeah. I think you touch on the competition with institutions a bit, but just would like to hear competition among your peers because BlackRock recently announced a dual custodian model with both Coinbase and Anchorage for their crypto
That's right.
holdings. And this seems to signal a trend toward custody diversification among institutions. And how should custody providers adapt to a world where clients want multiple providers?
That was already the case, right? It's very
Right.
uncommon for people to just have one prime, for example. People usually have one or two relationships for redundancy, for obviously pricing power, all of these other reasons. So I don't think, I never thought for a
Gonna be
moment in the
one.
beginning of starting Anchorage that there would ever be one. Think
Right.
about the concentrating risk. On the other end, you don't want to have many because the reality is that from a security perspective, you want to use the best. And if you start going down the long tail, and instead of having one custodian, you have 10, now you're actually increasing the chances of having problems because you actually now are using the best, but also the 10th best. And so you're putting your assets in a distribution curve, which actually includes eight that are not the best too. And so if you think about it, actually, this increases risk. It does not
Right.
reduces risk. Yes, it increases diversification, but it also increases risk. So people don't really like think about it that way. They think just diversification is better, but that's not the case at all. There's a threshold of competence, and there's a threshold of ability, and a threshold of obviously like auditing and confidence that just is not the same for the top five
Mm.
than it is for the top two. So if there's a duopoly here and there's two companies that win the biggest markets in the world, I'll be extremely happy to be number one.
Just make sure you are in the top two. Right. So another area that has exploded since last year is the crypto ETF. And you have noted that ETFs have been a really compelling vehicle for Bitcoin, but less perfect for Ether today without staking. And how do you see custody evolving to support more sophisticated ETF products, and particularly around staking and other network participation?
Yeah. So again, it's taken a long time for the regulators to get to be comfortable with Bitcoin and custody. And then all of a sudden, staking shows up. It's not that fast from our point of view from crypto, but from the regulators' perspective, these things are still weird and awkward. And are they rewards? Are they interest? Are they, the technology is different. Something that is a staking that allows you to lose assets, for example, tombstoning, which doesn't exist in many of these blockchains. But if you stake and are actually putting some of the principal at risk, that's very different than if you stake and you're putting the rewards at risk. And how the rewards are captured, and is it block by block, and is it every 7 days? How does it accrue? When does it accrue? Like, it's complicated from a technical implementation perspective. Where are these nodes? Where are they running? Where are they physically
Mm.
located? Geographically located? Do you have to claim the rewards, or do they just appear in your account? So all of these things are just different, and they can't all be treated the same. But in general, it took a little bit for the regulators to get there. Also, obviously, there's very exciting assets like Solana and Ethereum that do stake, and you don't want to leave the staking gains on the table, especially for an asset like Solana, which yields, around like, or generates these payments to the network for compensation for the consensus and helping them consensus of like 5%, 7%. You don't want to leave these
Mm.
things on the table. They're very high. Um, so it has taken us a while to get there, but funny enough, it is not from a technology perspective because custodians like us
Mm.
already have APIs that deal with this, already do staking for all these assets. It's actually no longer a question. Custody and staking are one and the same if you want to think about it, because you should never do staking. We should never do custody without staking, or at least allowing it to exist at the same level of confidence that you have the custody, because it just makes no sense for a customer to have to custody with you an asset that doesn't actually allow them to capture the rewards of participating in the network if they so desire. They don't have
Yeah.
to do so, but if they so desire. I think the hardest parts have been the trusts for these ETFs and the way that Bitcoin trusts have been set up. There's lots of questions around the staking components, tax questions, structuring questions, and so it becomes more complex. But it's more of a regulatory complexity and a paper
Mm.
complexity around how do you structure this in a way that is actually tax efficient and it works for the way that we want it to trade. And that has taken a while because obviously the regulators have to agree and have to approve, and also they have to get confident with the technology and how these things work. And it's a one by one asset thing. Staking in Solana is different than staking in Ethereum.
Mm.
So we're getting there now, finally. And there's, as you know, submissions for ETFs that actually have staking, and hopefully they get approved, and we get to list them alongside the Bitcoin ETF, so that people don't have to do the trade off of whether they, you know, have access
Mm.
and have exposure to custody or to exposure to an asset like Ethereum, but without actually benefiting from the participation elements.
Right. And from your perspective, spanning both operational experience and now venture investing, what are the key infrastructure gaps you're seeing in the crypto ecosystem that still need to be solved? Where do you see the biggest opportunities for innovation in crypto custody over the next few years?
So there's one base one which is perennial because the blockchains are not static. They continue to innovate, they continue to evolve. There's bridges, there's intents, there's so much complication. They're becoming faster, lower latency, higher throughput, which means that you have to keep up. And that means that new infrastructure has to come up. The
Mm.
infrastructure that was enough for Bitcoin was, or for Ethereum in the early days, was not enough to support the NFT boom, right? It was just not.
Right.
The transactions were very high. People couldn't handle it. Platforms were going down. They just couldn't handle the load. And so if you think about it, all of this has to evolve to keep up with the use cases. In fact, some of the use cases like stable coins being extremely successful bring new challenges. So there's new infrastructure being built. As I mentioned, Haun Ventures was an investor in Bridge. We're now investors in BVNK. So Bridge was acquired by Stripe for $1.1 billion. And BVNK is the largest stablecoin provider and router. And they're building routing that you'd expect, wait, why wasn't this built before? Didn't we already have
Mm-hmm.
crypto for so many years? Well, sure. But it turns out that when it's stables and you have to do FX and you have to connect these local on ramps and you're doing remittances, there's lots of these things that need to be done that are just not just generic moving Bitcoin back and forth. And so all of a sudden, there's a whole new swath of infrastructure, the money
Mm-hmm.
routing infrastructure that needs to be built that wasn't built before. And like this, the next thing will cause it too. So the reality is that you will never have enough infrastructure, and every new use case will demand new specialized infrastructure. So we'll continue to see that. Get the new wave and understand if you see the new wave coming, you understand which new infrastructure will actually be required. I think the needs have been decreasing across time. We're in a much better position from a block space perspective than we were 7 years ago. We have all of these chains that have high throughput, low latency. Those are amazing and allows you to do much better things than having to wait 7 minutes for a block or what have you. And so we're in a much better
Mm-hmm.
state. And so maybe in that field, there won't be as much innovation, but there will always be the actual final consumer use cases and money application use cases that will require different infrastructure. And so people are building them.
So yeah, more infrastructure to support multi assets and then different
Oh,
use
well, if you think
case.
about it, there's so many exciting things right now. Prediction markets, huge,
Right.
huge market, and there's so much needed to be built there. The interaction with prediction markets and decentralized exchanges, like there's so many things to build there. On the money routing side,
Mm,
there's so many like different on ramps, FX, messaging layers, trade financing tools, different countries. There's people building layer ones for turning these stable coins into one another. There's
mm,
lots of infrastructure on the consumer side. When do we have a global Venmo? There's no global Venmo right now. When do we have a global Venmo? There's so many applications that can be built. One of the coolest parts about stablecoins and crypto right now is that if you were a fintech before
mm,
stablecoins and you wanted to be an international fintech, you had to go, if you wanted to be in 150 countries, you had to go to 150 countries, get
right.
regulated locally, get partners locally, do the reconciliation, really deeply build engineering and product and integrate with all of it for the local ecosystem. And now with stablecoins, it's actually inverted.
Right.
From day one, you integrate with stablecoins, say USDT or USDC, and that is the Schelling point. You already have 150 companies that have 150 plus companies that are the local on ramps. They do everything for you and just give you what you want, which is this stabling, this stablecoin layer, which is the Schelling point of trade. And so you could actually be global from day one. In fact, one of the coolest parts of being a venture investor is that for the first time, we may have a shot at the first truly global fintech. If you think about
Mm,
Revolut, they're dominant in
yeah,
Europe, but not dominant in the US. If you think about
right.
Venmo, they're dominant in the US, not dominant in Europe. It's always been locality based for many reasons, but because you reach saturation and you reach network effects and you reach brand effects within your ecosystem. And when you want to hop to the next one, somebody's already occupied it. But from a stablecoin perspective, you're global from day one. So we may actually get the first truly global Revolut from day one that is built on stablecoins. And that's extremely exciting,
Yeah.
obviously, as a venture investor, because that's a very high return.
It's very exciting time for fintech, like you mentioned. And they think, Diogo, we have a few minutes left. As we wrap up, like what upcoming developments should our audience be watching for from both Anchorage and your investment activities at Haun Ventures?
Yeah, from Anchorage, I think you'll see a lot more. We acquired Mountain Protocol, that's public. You'll likely see more acquisitions coming. You'll definitely see a lot more stablecoin announcements and exciting stuff there. You'll see us pushing on our settlement. You'll see the company continue to grow. I think we're doing extremely well right now, and it's just been so proud of Nathan and the team. It's been an amazing journey, and I couldn't ask for a better set of people to work with. It's been obviously ups and downs of the volatility of the market, but
Mhm.
again, the hardest parts and the hardest things are the things that are memorable and you really are proud of. In terms of the ecosystem, I think you'll see a lot more coming in prediction markets. You'll see these applications that are focused
Mhm.
not just on the American and European and developed markets, but developing markets. You'll continue seeing stablecoins. I believe that stablecoins will likely breach the top 10 holders of US treasuries very soon, within the next, say, 12 months. That's going to be a major effect on crypto and the importance of crypto to the world. You'll definitely continue to see regulation coming out and the regulators jumping on the bandwagon, which is pretty interesting. I really hope that 2015 and 2016 are the year of the money apps, because right now we've had the money issuers, which generated all the revenue. Then we've had the money routers, which generated
Mm.
some revenue and have supported the money issuers. And now that we had them, we have the money apps, these kinds of global Venmos, peer-to-peer, these kinds of like consumer products that are building really cool experiences, global cards, global issuance cards, all this really cool stuff that has a lot of impact in developing countries. I hope that this is the year of the money app, and I am seeing a lot of inklings that it is.
Right, exciting. Any calls to action for founders or institutions looking to engage with you?
Well, if you're a founder and you want to look for something exciting that you should build your company on top of, look no further. Stablecoins are new money rails. They're actually changing the game on how these systems actually work. If there's a use case that touches cross-border transaction and changes countries, then stablecoins have a role for it, and you should be building on top of this new rail. And if you're building one of those companies, ping me on Twitter, send me an email, do something, and I'll take the pitch.
Well, thank you so much, Diogo. Yeah, that's a
Of
lot of
course.
insights for the custody, yeah, in the digital asset era. Thank
Thank
you.
you for having me. Bye.